money is more weighted on the daily, on the higher time frame, on the daily, weekly, and monthly. You know, the higher the time frame, the more money there is, right? All right, so the money is in the higher time frames. What do I mean by this? A lot of traders, I don't know, and I don't think a lot of traders understand where the money is exactly, because we don't have a concept and understanding on a psychological aspect, and maybe on the visual aspect of where all the money is. But as we all understand, money is in every time frame. However, the money is more weighted on the daily, on the higher time frame, on the daily, weekly, and monthly. You know, the higher the time frame, the more money there is, right? However, right now you can see I'm on US Tech, the US index, right? The daily is all you really need, honestly, but sometimes you need to go on the weekly and or monthly just to get more insight on the higher time frames, right? But in this case, the daily would work just fine. Now, the reason why I say the money's in the higher time frames is because a lot of traders, especially banks and financial institutions, they utilize the higher time frame still. Okay, now it's not necessarily that all the institutions, financial institutions, are actually good at trading, because a lot of them, you'll be really surprised that they're actually trading, normal. The way a lot of retail traders trade, right? Break and retests, supply and demand, and all that stuff. That's not to say that they don't know what they're doing. They obviously, every trader has an edge in their in their trading. Specifically, in retail trading, there can be an edge to those retail traders. So in this case, in our case, let's just say, we definitely trade the market just a little bit different, if not the same as liquidity traders, but we have a different perspective in trading. So to go back to the title of this video, money's in the higher time frames, we generically want to start on the daily and or the weekly or monthly. The only reason why is because the big financial institutions, banks, trade the higher time frames, right? So if you see, pretty much this whole move running bullish like this, right? This impulse, retracement impulse, you can see that the banks aren't in it for a short term, right? The financial institutions are not in it for the short term; they're in it for the long term. Not necessarily longer than we'd expect, like you would trade, like, for example, like stocks. However, but they're in it for the long term, right? To get the big juicy move that could be lasting, days, weeks before, their trade completes, right? So in this case, I just want to go in here and zoom in and show you what I'm pretty much show you the examples of why the higher time frames is where the money is. So let's just put this in perspective. You can see this high ran the lows over here. You can see there's a bunch of liquidity. Right here is an implication where I would see where it would meet my criteria in terms of liquidity sweeps, right? We would wait for something like this to be swept on the higher time frame daily, i.e. the daily, and then wait for prices to open here on the sessions, right? So we trade the New York session on the US Tech, right? And so we wait for New York to come in here and to switch up and then to open up and then switch bullish, right? And then we'd buy, right? Now, I don't hold trades, obviously, days upon weeks. I'm an intraday trader, so I'm in and out on the current day session, all right? So the reason why, again, banks, I just kind of want to mention this again, but the reason why, again, banks and institutions trade the higher time frames is because they're more willing to wait for the markets to readjust, right? They're waiting for prices to come and meet their criteria, right? They also have a lot of investors' money that they're trading as well, right? So they have to take things a little bit more sort of serious in terms of trading, their investors' portfolios and stuff, right? So investors' capital. So in this case, again, we see a daily sweep like this. This is how I always start my day. We see the daily sweep, right? And then we can see that internally we want to have price run bullish, right? So my expectation here is to always wait for the internal sweep. Okay. Now, a lot of you may be wondering what the internal sweep looks like exactly. Well, similarly to what you see here, the daily sweep, we're going to be looking at into the internal impulse move, right? So right here, you can see once the market opens, actually, let me even draw it back here. Okay, let's say the market swept here, right, on the daily, right? And let me just actually do this, cut out the market here, just to kind of give you guys an example. Even this would be better right here. Okay, so right here, you can see that I wouldn't be trading anything, right? Because nothing has swept on the daily, the internal daily. So this is the external daily move right here that swept. And then the internal daily hasn't actually swept anything until, right, price comes in here. Now this is obviously too fast. We know the markets don't run this fast, right? Until we see this happen, right? Then I get an alert. Let me actually take this off and go on the 4 hour. I'd be on the 4 hour, right? Wait for the 4 hour to sweep. And the daily as well. Okay, there we go. So we have that swept, right? And then we'd be on the 15-minute time frame. Now, here's how it really works, okay? When the sweep happens, we essentially want to correlate the daily time frame within the 15-minute time frame and then the 1 minute, okay? Generally speaking, you need 2 time frames to confirm the entry. You don't need 3. In our perspective, you don't need 3. So right here, if I zoom in, once we swept this low, this liquidity, right, you can zoom in here and then time the markets with your session. That's how we trade, just like this. Okay, so you can notice here, New York started to fall. You can see New York was the one who, was it New York that actually swept here? No, New York didn't sweep, but this was the Australian session right here. So we'd wait for New York to show up again, right? So let's wait for New York. Let me see what time this is. This is 1:30. So this is London right here. London just opened. London ran up, swept some more liquidity right over here. Okay, so it swept a little bit, retraced again. It's recorrecting price here. Oh, let's go back here. All right, so this is New York. Right here is where we'd be expecting for price to fall in, just like that. Okay, do you see that? Price fell, took out the liquidity on the 15-minute. And this is where we'd expect the entry to be, right there. I put my risk to the nearest demand zone right here, or the imbalance, depending on what I see, whatever presents itself first. And then we target literally the supply zone. Now, there's a whole reasons to this, to why we do this, but a lot of it, the simplest term is really just for safety. For safety reasons, we don't want to over-predict and or over-anticipate that the market's just going to break this high, right? Because we have to understand that scenarios can always happen here where price may not sweep this liquidity just yet. It could just respect the supply and then continue to fall bearish, right? Anything can happen in the market. So that's why you always want to be patient, right? So notice how like I mentioned, the money is on the higher time frame. Again, we started from the daily, worked our way down on the 15-minute. We saw the 15-minute liquidity sweep. We went on the 1 minute and the 1 minute, excuse me, not the 1 minute, but the 15 internal structure right here. Liquidity was also swept. So we would be entering in there on the 1 minute to target the supply zone. And that's all you need, right? That's the current day session move, right? Now, I'm not in this for the long run, obviously. This could obviously run, but you can see over here, the session just ended. Let's go down. Let's go up to the daily again, and let's go to look for another sweep. Okay, let's play it now. Technically, I would not be trading for these days. There's your 1, 2, 3, 4 days, right? That's almost a week right there. Okay, that's 5 days. All right, right here. So this would be a good idea right here. A good idea, a good area where price came to sweep the daily internal liquidity, right? Notice again, we had the external daily and then we have the internal daily. So now we are anticipating for prices to shift bullish. Let's go here. All right, so right here you wouldn't have had time to trade, right? Because New York opened up here, it swept more liquidity and it ran bearish. So in this case, I would refrain from even looking to trade this day because New York just ran bearish and now it's running bullish, right? But we need for price to recorrect itself, right? We need for it to rebalance itself and also take out some liquidity. So now we're going to wait for New York to open up again. We are currently in the London session. London actually came here, I believe. No, London didn't. That's not London yet. Okay, let's fast forward this. Let's go wait for New York. New York is just about to open. Oh, it just opened. Okay, I ran a bit too far. If you run your ISO, you can see there's a high, there's a low. This is an internal, very small move here. It's not something I would be running for to enter there. However, it is a type of entry. Let's just say for all good measures, if I was seeing that, I could just enter there. Risk right below, filling up the imbalance gap, because that's what it is. Here's your demand zone right there, right here. There's your demand zone, right? Somewhere in there, right? And I would just leave my risk like this, right? So now we got to target the nearest supply zone. Nearest supply zone, there's a bunch of them, obviously, but in the bigger impulse that push price down, you can see there's a high, broke this low. We can target this supply zone at minimum, right? So you can do that for a target. However, like I said, this may not be my ideal entry here because it is a small internal sweep where I would be really looking for the slow to sweep here. Okay, because there is liquidity here. This is inducement for this demand zone here. That means I would have waited for New York to come and sweep this low. Essentially trade what you see, not what you think, right? Because I can see that, right? But on a line chart, this doesn't align with my strategy. You can see that price didn't come and take out that low. It was just a quick wick, right? But on the lower times, of course, it did. But I'm waiting for the 15-minute to sweep, right? But again, this just goes to show you that, the momentum is bullish, right? We swept a bunch of liquidity here. Now we're looking to go bullish. We swept all this liquidity because that's where the money is. The money is in the higher time frames. And this is just a safe target, obviously. You can do whatever from here. Oops. Let's see what happens. Okay, so price just impulsively runs bullish. Here's another actually opportunity where there is a bunch of liquidity here. Okay, and this was another opportunity actually right here. So you could have looked to enter here, right? Fill in the imbalance, cover the imbalance, just like that, and then target the nearest supply zone, just something like this. Let's see if anything happens here. Okay, so it did. This is obviously the next day open on Australia. You can see price left an imbalance, right? So you would have had to cut off your trade here immediately because the close came there. But just wanted to show you guys, again, it's nothing new on our end, especially. This is what we do every single day, right? Now, realistically, we want to be targeting this high with where all this liquidity is because, again, this is the major daily. This is the internal daily, right? So we know the money is in the higher time frames. It's leading price bullish, right? This is where the banks and institutions look at, right? We're just a part of their game. So go on the 15-minute, right? Let's wait for the next day. Let's see where New York opens. Right here. That's okay. London's coming out now. All right. Oh, London's. There's New York. Okay. So what I would expect here is to have all the swept. Let's see if price comes back. It looks like it won't. Okay, there you go. It just did. All right, so this would be my entry right here, right there. We could look to hold it on this demand zone. Let's see what happens. Okay, this would have been either a break even or a loss, but I'll tell you this much. If price came here on the 15-minute and price is over say over 9, it's especially 10 a.m. If it was 10 a.m. Los Angeles time, you can see there. If it was 10 a.m. Los Angeles time, I wouldn't be really entering in because I don't see the whole point of buying later and then holding price all the way to the to my desired target. However, for this video's purpose, let's just see what happens, and we would have been swept out, no problem. So that would be a loss there. Let's go to the next day. This is 4. Okay, this is London. Let's wait for New York to come open. There's 6. And we actually, let me just tell you this. We did take all this liquidity here. We did fill the imbalance, part of it, right? So that would have been filled in. Then I would wait for New York. New York looks like it's taking off. So sometimes you get opportunities like this where, excuse me, not opportunities, but the market just starts setting off on its own like this, right? And this impulse is actually following this last liquidity sweep. So I could, generally speaking, I could go down the 1 minute and look for internal sweep in there to continue price bullish, but that's only if it happens, right? So there we go. That would have been a TP if you caught that on the 1 minute. I wouldn't have. Now let's go to the daily, right? We've met the target right there. So now we wait on the daily again, right? So remember the internal daily low was swept. Price is running, right? We could have been trading there for what? I think it was 3 days. Give or take, there's 1, 2, and then 3, right? So you had 3 opportunities to look for buys in there. And so that's what happened there, right? All right. So we had 1 win, 1 loss or break even, and no entry for that day. Let's go on the daily, and now we need to wait for the daily to recorrect itself, right? These are strict rules. You can't just be, there was something actually there. I didn't look at that, but that was a sweep. Can you guys see that, right? Can you guys see all this? That was a sweep. So that, we would wait for the liquidity to be swept. Again, run down on the 15-minute. And then, lo and behold, you can see this happen. Look at that. So the liquidity was swept by New York. New York fell. New York ran bullish. We'd wait for New York to recorrect itself. Swept again here. So that would have been an entry to go along here, right, with the risk right at the demand zone. And then we target the nearest supply zone, which is right up here, right, for, what is that, 4.3%, right? So that's pretty cool, right? Something like that would be great. So notice again that the money is on the higher time frame, right? This still has so much more power to push price up, right? Don't ever for 1 second think, oh, just because this is a supply zone, I gotta be looking to sell now, right? Let alone sell from from this supply zone to run price bearish. This is still bullish. You can also see the evidence here that this high took out all this liquidity. So when you take out liquidity, the momentum has to rise up, right? At least that's what we're looking for. Let's look for another internal sweep. I do see something here actually. Can't place that right. But there we go. That would have been an internal sweep. I see the liquidity already. We go down on the 15-minute. Okay, and I think we have another winner, right? This would have happened on New York, right over here. Okay, all this is really just timing. In here, I don't quite see my setup. Maybe on the lower time frames. I would actually say, yeah, I don't see it actually. Even if I do the line chart, I don't see it. But you would wait for an internal sweep again, right? But we still understand that the direction is bullish. It hasn't changed its direction. Direction is powerful, right? We want to be abiding by the direction, and then the 15-minute just needs to correlate with the daily. That's pretty much it. Right here, you guys can see a bunch of liquidity is swept again. So what I do, right? Liquidity swept. Wait for prices to come and run the low, right? Risk right below, right to the fill of the imbalance, and at the demand zone, and then you would go in right for the buy for the kill, right? Just like that, right? Notice how I'm not fighting the direction. Notice I know where the money is, right? Because all we're doing here simply is we're trying for price is running up now to take out all the internal liquidity, right? Essentially to what we call is to fill in the void, which is this. This is a void, right? So once it takes out all the liquidity like this, right, the market already completed, it would have completed its job before prices need to now go ahead and take out this liquidity, right? Just like that, right? It's never going to be always this smooth, but if you have the right, thought process behind this, it should work, obviously. So let's do another example, just to show you guys. We're looking on the daily, internal daily sweeps. There's nothing here, nothing here. There's one right there. Yep. Notice that this must be an inducement, right? Let's go here. All right. This is as simple as I can be the way I trade. This is why I can breathe. I can relax. I'm waiting for the dailies to switch, right? That's it. The higher time frame, the banks and institutions only have one idea here, is that they want to take everybody out in the higher time frame. They're only playing the higher time frame, right? If you're playing in here, all this in here, you'd have lost a bunch of money, I'm pretty sure you would have, because there's no set direction in here, right? But once the main liquidity has been swept, price runs. So in here, you can see that evidently New York opened right here. It just ran. It never swept. However, we can imply or implement a few things here. Once the liquidity swept here, again, we have more liquidity here. So that was swept by London. You could look to enter either 15 minutes before London or after, right? This is up to you. This is what we do. We target the supply again. All right, that would have been the whole take, our take, all right, and we'd be done. Actually, I'd have this lower here to cover this demand. Not this low, but this demand right there. So that would have been it there, right? Let's do one more example. Hopefully you guys can finally start seeing what we're doing here. This is a supply zone here, all right, but normally we're not held back just because there's a supply zone. We'd be careful, obviously, but knowing that all this liquidity has to be swept. So let's wait for another sweep. There's a sweep there, right there. Okay, so let's go back on the 15-minute. Okay, right here. So notice again, we had more liquidity sweeps. I would have come back down here, waited for this low. This is London. Must have been news. London ran up again. New York came down, filled in some imbalance. Nothing happened, but then we have more liquidity swept here. So I would have been able to take this entry right here. Enter here, right, with my risk here, and target this supply at minimum. That's where I would have ended. But then you got to ask yourself, is the risk to reward that good? It's 2.2, right? Normally I'd target 3% and above, but 3% is my minimum, all right? So let's go on the daily one more time. Let's go look for some more sweeps. Nothing in here, nothing here. I would be skipping a lot of days, and it's no problem. This seems pretty good. Let me see if this actually swept here. And nope, nothing yet. There we go. That would have been it. So there's your liquidity. I would be in here. This had to be a bank holiday, most likely. Price ran already. That's fine. So it ran without us. Let's look for the next day. Let's wait for right here. You can see how price came in, took out the low with this wick, right? So it hasn't really taken out yet. But this big candle came here, took out this low. So that counts. Okay, there we go. There's our entry right there. I was looking at this. So I was still looking for buys right here. We would enter, risk at the demand zone, target this near supply zone, which would be right there, actually. Just right here. And we'd be complete right there. Okay, this one would have been a very bad entry. It's not entry, excuse me, a TP if I had, let me see, did I get that right? If I go close in here, there's your high to low. Yeah, that would have been it. So we might have been dinged out for a break even here. This would have been a break even, but look how sneaky it is, right? Look at that. There's no way you can always be correct, right? But you guys got the right idea here. You see the right idea of what I'm doing here. We're going with where the big money is on the higher time frame, right? And knowing that the U.S. tech is a buyer's market, we'd be focusing on buying most of the time rather than selling. So hope you guys like this video. Throw a huge thumbs up on this video, and go ahead and comment on this video and let me know what you guys like, and if you guys want me to do any other videos, something similar to this. Until then, we'll see you in the next video.